Welcome everyone. I'm Sean. How you doing? I'm going to talk to you about an investment strategy called a call option. I'll explain what a call option is. I'll walk you through an actual trade that I'm going to do. It can be a really good way to manage your risk reward if it's done properly. Also note, I think I'm going to use the wife's money on this one. You know what I'm saying? If you see me out in the street living in a box, you know this trade went the wrong way. See, is she around here somewhere? Okay, I think we're good. As a disclaimer, I'm not a financial advisor. I'm just a dude in a Starfleet uniform. Ferengi Rule of Acquisition number 89 states that ask not what your profits can do for you, but what you can do for your profits. All right, let's get right into the basics of a call option. An option contract is also known as a derivative. This is a pretty good investment strategy that can gain leverage over an investment. Buying a call option. This is a contract where the buyer has the right, but not the obligation, to buy a stock at a predetermined price. One call option gives the buyer the right to control 100 shares of a stock for a certain period of time and at a certain strike price. Today is April 20th, 2020, and we're going to look at a particular stock, the NGT, Newmont Corporation. Okay, it's a gold producer. They also produce copper, silver, zinc, and gold has been going up recently here. I think this will be a good play. When I do a call option, it is referred to as a bullish trade. Okay, that means I expect it to go up in the short term. Okay, this is a short-term play. It's not a long-term investment. The current price of NGT is $84.41. That is what it's trading at this very moment on this day. Now I'm going to this site here. Go to tsx.com. I'm trading this on the Canadian side, and click on options. Select call options, and let's take a look here. Now, the expiration of these contracts are the third Friday of every month. Okay. Now, I'm going to select May 15th, 2020 contract expiration. And what you see here, okay, is the price of the contract, the bid, the ask. Okay, there's a fairly wide spread between the two here. The open interest and the strike price. The strike price refers to the price of the common stock. Now, when you buy into this contract, remember that means that you're going to control 100 shares of the common stock. So what you have to do is multiply this number right here by 100. So then what you're actually paying out is $575 plus any commissions from the broker. And what that does, it allows you to control 100 shares of this stock at a price of $84 per share up until May 15th, 2020. So if you expect this stock to go up further, and let's just say the stock is up over $84, let's say it's 88 or so, okay? Then by the expiration date of May 15th, you can exercise this contract, which means that you collect those shares, 100 shares of the common stock NGT at the price of $84. And you have the benefits of the profits that you make between $84 and where it is on May 15th, assuming that is higher, okay? Now, if the stock is less than $84, well, then you're going to lose money on this one. Now, what I recommend is that you buy the option contract in the money, okay? What that means is that, okay, today is trading at $84. I would like to have control of the strike price under $84, 82, 80, and so forth. So that's referred to as in the money. If you wanted to buy it at 84 strike price today, that's referred to as at the money. And if you wanted to own it at a higher strike price, that is out of the money. Now, if you look at the value of the contract here, it gets cheaper as you go out. and it gets more expensive once you get more in the money. Okay, so here's where you need to do some calculations and decisions. I highly recommend that you buy in the money. So what I'm going to do is I'm going to go after the 82 strike price. I'm going to be in the money. And I'm going to buy one contract, May 15, 2020, 82 calls at a price at $5.85. Okay, I just executed the trade here in Questrade. This is the broker that I'm using, and if you take a look, I do have some of the common stock, but pay close attention to the call option here. I purchased one contract at $5.85, which calculates to $585 that I'm actually paying. Remember, you have to multiply that by 100. Today's date is April 23rd, 2020. Now, this is the options chain that you see here as of April 23rd. Okay, and as you can see, for our 82 strike price, it was last traded at $7.70. Now, as I mentioned, this is a short-term trade. Do not get greedy. Okay, so markets are very volatile right now. This is something that I want to be able to capture. I'm going to try to sell this contract today. Once you reach the expiration date, there are a few options. You can roll forward the contract to the next expiration date with a fee. You could do nothing and let the contract expire worthless. You could exercise the contract so you can then collect your 100 shares of the underlying security at the predetermined strike price, or you could sell the contract. I plan to sell the contract. The current stock price of NGT is $88.61. I managed to sell this contract at $7.65. Let's take a look at what that means. Let's break this down here. When we look at the stock price of NGT, and this is traded on the TSX, Toronto Stock Exchange, and the price, okay, on April 20, 2020 was $83.68, and that is the end price there. On April 23, 2020, it ended at 88. If I wanted to purchase 100 shares of the NGT at a price of $83.68, then I'll be spending $8,368 plus commission fees. Alternatively, if I wanted to exercise the contract, then I can pick up NGT at $82 for 100 shares, which will be $8,200. That is still a sizable amount of my capital, which is why for this trade, I just wanted to trade the contract, so I'm risking less a dollar amount. This went up 5.2% gain, okay? Now the call option that I purchased, which was the May 15, 20, 82 calls, okay, was at a price of $5.85, okay, and on April 23rd, I sold it at $7.65. Now remember, we have to multiply this by 100. But also, the commission fee and Questrade is $10.95 per trade for options. It's $4.95 for stocks, free ETF trades. Now let's include our commission fees in this calculation. $5.95, 95, $754.05, which includes the commission fee when I sell the contract as well. And that is a difference of $158.10, which gives us a 26.5% gain, and this is net profit. It's a pretty good gain that I get within those 3 days. Now, buying the common stock is something that is more of a long-term scenario. If I wanted to get into bigger options contract positions, I simply have to purchase more contracts. 2 contracts gives me the right to control 200 shares of the common stock, or 300 or 400. Then I'm just increasing the amount of money that I'm risking here. Also note, in Canada, I'm using a TFSA. It's a tax-free savings account, and this is traded on the TSX, so it's domestic income. Therefore, I don't need to pay tax on the gains. I will discuss more investment strategies on the next video. I hope you found this video informative. Wife is going to go buy shoes. How many shoes does she need, honestly? Don't forget to hit that notification button when you subscribe so you don't miss the next video. See you next time. Yeah, boy!